Hey guys, this is Scott Horne, and this video is going to talk just a little bit about generic information about asset-based or hard money lending. If you like the video, guys, don't forget to take a moment and like it. If you got any comments, take a moment and comment below. And don't forget to subscribe to our YouTube channel. So asset-based, also known as hard money lending, is a great tool for the real estate investment community. Keep in mind, guys, asset-based hard money lending is really there as a short-term access to capital. It is not long-term lending. If you want to hold an asset, a property long-term, you need long-term capital because the interest rates and the terms are going to be greatly different than that with a hard money lender along the way. But briefly, some of the things you need to know about hard money lending is hard money lenders look at the property first and foremost, and its value, its location. Typically, they like to lend about 70% of the after repaired value. That can actually go up a little bit. It can also go down a little bit. You're going to have an interest rate, and usually that interest payment is interest only. Rarely do hard money lenders do amortized loans. Next, there are going to be fees involved in a hard money loan. There's going to be points. Well, 1 point equals 1% of the loan amount, not your purchase price or the appraised value. It's of the loan amount. They may have some fees that they're going to charge. Those fees could be everything from an inspection, from an appraisal, or maybe a broker's price opinion, maybe a loan processing on your behalf in setting your file up and analyzing your application and those things. And then a fee to draft the documents for you. Now, they're always going to want title insurance. They want to ensure that they're in first lien position almost every time. And so when borrowing money with a hard money lender and buying a property, in so many cases, we investors wind up paying for the title insurance ourselves. Maybe you get lucky and you negotiated a situation where the seller pays for that. That's awesome if you can do that. And those are going to be your basic lending fees for hard money lending. Now, along the way, obviously, if you're doing repairs to the property, a lender is going to want to inspect the property so they can release those dollars. Now, sometimes a lot of people think that you come to a hard money lender to borrow acquisition capital, but you want to expend your own money doing repairs. Now, so long as that fits the loan to value situation of your hard money lender, great. They don't have any problem with that. But if the fact that the monies that you're holding to make repairs gives the lender a different loan to value that doesn't fit, you may have to escrow some or all of those repair dollars with the lender. Now, they're not going to charge you interest on that money, but they are going to dole it out to you as repairs are done. So most hard money lenders are going to hold some type of an escrow account for repairs to the property. They rarely will give you the money up front, although I've seen some do that. They're not also going to nickel and dime you, but you've got to keep in mind that every time they give a draw to you for repairs, they're going to want to have someone, one of their inspectors, put their eyes on the property and make sure that those repairs have been completed in a good and workmanlike manner. A lot of times lenders will not lend you money just because you have delivered materials to a property. So simple reason why. Those materials can grow legs and walk right out the front door, and it happens all the time. You buy cabinets for your kitchen or vanities for your bathrooms, but they're not installed, they get returned. You buy hardwood flooring maybe, it's delivered to the property, they get stolen, they get returned. That's why lenders want to see these items installed, and then they will lend out to that money. Some want these done 100%, others will partial it out. If you're 50% done with the hardwoods, they'll give you a draw for maybe 50% or so. Things of that nature along the way. But the bottom line is, keep in mind why we have hard money lending. It's for quick, easy access to the loan. They care about the property first and foremost. From my end, they're going to look at your ability to prosecute and navigate that transaction from repairs to the back-end marketing and sale of the property, that's awesome. But rarely they look at your credit, because really all credit does for a hard money lender is it tells us what your ability is to refinance a transaction and cash out that loan, other than just a traditional sale of the property. Now, if you've got a deal that's tight, will hard money lenders still do the deal by reducing that loan to value? They may. It simply is a way to protect themselves from the worst case. And also keep in mind, so often the investor forgets common sense things. The hard money lenders will look at a transaction in a way where if the bus hits you tomorrow and they have to take that house back, unfortunately, are they going to be in a good position where they're able to, with the funds they have available, finish the renovation of the home, get it to market so they can pay off their loan on that property? They're there to make a loan. They make money on their fees and their interest. They're not really in the marketplace to take advantage of you and take that property back in most cases. So guys, I hope you found this video helpful. If you liked it, take a minute and like the video. Don't forget to comment, and don't forget to take a moment and subscribe to our YouTube channel. We'll look forward to seeing you all next time.